Hello and welcome to another episode of Dealroom video podcast. We are here in Dealroom headquarters, now studio, to discuss the question of startup definitions with Orla Browne and Yoram Wijngaarde. What is the reason? Why are we actually talking about it now, Yoram?
Yeah, so startup definitions are our kind of bread and butter. We work with over 100 ecosystem partners around the world. At Dealroom, we help them to measure their startup ecosystem, to understand how it's functioning, how what can be done better. And so we deal every day with this question, like how do we actually define what a startup is? And yeah, we've put a lot of work into this over the last, call it 5, 6, 7 years. And yeah, there's a lot of definitions already out there that definitely don't really work for in practice. I think so. That's why we really wanted to talk about it.
So, out of curiosity, how many times has your own definition of startup changed so far?
So actually, the kind of the guiding principle around it has never really changed. So we used this from Paul Graham company, designed to grow fast. That has always been kind of our guiding
And that
principle.
one was coined a long, long time ago, I think.
Yeah, I don't even know how long, but yeah, it's really powerful. However, there is also a problem with it because I think it is this is definitely a good starting point. And because there are also definitions out there that talk about, oh, if you are maximum 50 people or things like that, that really make no sense at all.
Yeah.
That we'll get to that in a second. But this definition, although it is really nice, it's not. It's also qualitative and not quantitative. So it's actually for us hard to apply this to a data set. That's also not why he came up with it, I guess. But taking this as a foundation, we have kind of elaborated on it and created, like a system that also makes it more applicable and quantifiable.
Right. So this was the starting point then.
Yeah.
But then maybe we can also talk about some of the things a startup isn't, because there's, again, a lot of people will say, oh, but isn't it a company that is recently founded, or is it a company that has a certain number of employees? Why do you call Google a startup still? Because they're one of the biggest companies in the world. And actually, it's useful to have this kind of broader term because, if you were to say, well, a startup has to be a tech company. That's not necessarily true. Like we can look at WeWork, we would have called a startup, but there's not a. It's also kind of mostly a real estate company, for example. Or you could say a startup is an innovative company. Well, there's lots of innovative companies. I remember you gave an example of like El Bulli, the sort of 3 Michelin star restaurant, best restaurant in the world, very innovative. We wouldn't call it a startup. So these are some characteristics that are often there with a startup, that it maybe is tech enabled, because the tech allows you to grow fast. So again, back to the kind of Paul Graham point, it's the growing fast that's the important bit, not the tech, not the innovation, but that it's scalable and can grow quickly.
So the scalability. All right. Okay. If we have established that, what are the other like 30 slides that you have prepared?
Well, yeah, exactly. Well, let's just go into it. I mean, we can talk for hours about it, but we'll try to keep it a bit shorter. So it's really helpful to think about the different stages that a startup can be in. And this framework has been kind of developed by us, but really with taking a lot of inspiration from some VCs that we've spoken with, including work we've done with Local Globe and Atomico. So you can kind of think of it as you have the moment of inception, and then you have the actual startup stage, where you are literally starting up.
Yeah.
And the primary goal at that stage is to find product market fit. And startups that fail you can basically sum it all up in they didn't find product market fit. They didn't build something people want.
That is startups that fail at this stage.
That's exactly, that fail at this stage. If you do find product market fit, so then by definition you experience pretty rapid growth. People want your product.
Right.
You will almost certainly be able to get funding. Even if you don't make money, you'll either make revenue or you'll be able to get funding. I think there are very few people that wouldn't be able to raise if they have found product market fit. And I think a lot of companies actually get into the issue where they either don't truly have product market fit or it's kind of weak product market fit, and they get into this kind of twilight zone. But if you have properly found it, then you get by definition automatically into kind of the breakout stage, where you experience rapid growth, and at that stage you have new challenges. For example, finding ways to actually sell this product in a repeatable manner. You also need to need to basically not break the company. And I like one really kind of unfortunate example that comes to mind is Van Moof, the e-bikes. So they clearly had product market fit.
Absolutely.
Like people really loved their product, but then they had issues with maintenance and reliability. So they experienced rapid growth, but there was kind of like a wall coming at them. It can also be that you're not able to have retention, or you're making a loss on your product, for example. So those are the kind of things that you need to solve at that stage.
And then it can take a pretty long time in this case. Like for Van Moof, it took quite a while between the inception and this product market fit until they actually hit that wall.
Totally, yeah. These stages have nothing to do with the number of years that you exist. Like in theory, you can take 100 years to find product market fit.
Yeah.
Or you get it in 1 year, but you need 100 years to find a way to make it repeatable. So this has totally nothing to do with how long you've been in operation. Although, of course, in practice, you hope to not stay too long in each phase.
Most VCs are not a particularly patient lot anyway.
Yeah, no, exactly. I think exactly that the mistake that a lot of startups make is to work on things that are actually for a stage that you're not in yet. So you're trying to scale. A classic example is that you're hiring a bunch of senior execs when your goal is to find product market fit, and so you don't need those people. You just need to work on product market fit.
Right. Yeah, that makes perfect sense. So we have startup, breakout, scale up, all without hyphens, fortunately. Because that's my own pet peeve. I'm sorry. Like having some people have hyphens only in scale up, some in both scale up and startup, some nowhere.
Yeah.
I really want to finally set in stone like one way to write it. Whatever it is, just like let's just agree on one.
It's definitely no hyphen. The Economist even updated their style guide a couple of years ago for startup as no hyphen.
Okay, startup no hyphen, but scale up.
Scale up, well, at Dealroom it doesn't have a hyphen.
Okay. That's part of the definition then.
Exactly. At least we're consistent. So then with this same framework, you can also look at kind of the type of rounds that are being raised at each stage. So typically at the startup stage, you raise from maybe first get some kind of grants, friends and family, angels, early stage VCs, and we define this stage to be where you raise a pre-seed round, a seed round, or a Series A round, which we have standardized into kind of different brackets. And the reason we did this is because self-reported rounds, there's no consistency around them. Some companies,
in terms of labeling, you mean?
Yeah, they raise like a 50 million seed round. But it's like not really a seed round. So this self-labeling often gets gamified for PR reasons. Occasionally it does truly happen. But basically, when you're raising that much money it's kind of assumed that you're then coming out with already product market fit. Probably you already, it's assumed that 100% that you have it, rightly or wrongly. Like often also that then goes wrong because actually you didn't have it. But yeah, sometimes there are these founders that have so much experience that investors just they will say, okay, this is a kind of 100% probability that they will reach product market fit.
Yeah, so we in Dealroom we record the reported label as well. So if checkout.com says they raised 200 million as a Series A, then we record that as a Series A. But in terms of doing meaningful analysis, it can really skew the figures if you want to sort of compare how much is being raised at Series A in the UK this year versus last year. Well, that's not so helpful if you've got these outliers. So we do this round standardization as well, which we use in the analysis. So and these numbers come from analysis we did of all of the rounds to see what sizes those are typically at the different first institutional round, how big is that round, and so on. So this is what we kind of refer to and how we judge the companies, what stage they're at for kind of aggregate analysis.
Right. So basically, the amount of money defines the stage in this case.
Yep.
Yeah.
And of course that's a huge simplification. So it's kind of like a heuristic basically. But it just works like a charm in 80-90% of the cases. Yeah.
Right. And then for mega rounds are sort of explainable, but then like how do you define where mega rounds begin? Like 100 million, is it an arbitrary number?
Of course, it is arbitrary, and you try, like everything in the end is somewhat arbitrary, but you try to keep it also simple. 100 million is what we consider to be a scale-up capital. So we also refer any round from pre-seed to Series A as startup capital. Then you have breakout capital and scale-up capital. And these terms, after you get used to it, it really sticks. It gives a lot of meaning to those words, because if you say like late stage or early stage, I know that's like the vocabulary of VCs, but I think it's a very VC-centric and kind of institutional investor kind of way of thinking, whereas it is about the startups. And if you say like it's startup capital, then you're like, okay, this is probably a company who is working on finding product market fit. And then you have breakout capital. Okay, that's meant for companies that have found product market fit, and they're trying to figure out how to sustain that growth and to make it kind of, work on the unit economics and the margins and everything we just discussed.
And that scale up then is for the company. It would say that the company has figured everything out and now it just needs money to grow.
Kind of, yeah, exactly. And then there are always companies that don't fit into these boxes, and it's also interesting to highlight those.
Right.
So we did do also some work on mapping the data onto this framework. Yeah, you can see what all these stages look like in terms of valuation. So typically there's a kind of 3x step up in valuation, and at least between rounds in the startup stage and breakout stage. We've looked at how many people these companies typically employ. And so you can also look then at how these kind of things change over time, what a top quartile or a bottom quartile startup looks like. So these are just some examples that having a framework then immediately allows you to do kind of meaningful analysis. And yeah, disclaimer. So we're talking about regular startups. There's also you have also deep tech startups that have a slightly different maybe journey. Although since actually we made this slide, we did already a couple of deep tech reports where we show that in fact the deep tech journey is not that different. Like the time it takes to reach certain amount of revenue is a bit longer, but it's not as different as
funding sources might be different though. Like it's more like grant funding, for example.
Yeah, probably. Actually, there might be a bit more grant funding, but really the differences get overstated. And then you have biotech that is a bit of a different world where you have all these testing phases. But I think even there, with the advent of AI, biotech startups are going to behave more like regular startups. So this kind of so far definition. Maybe talk a little bit about why startups matter to begin with.
Good.
So there's been over 50 trillion of enterprise value created by VC-backed companies in the last 50 years. And to give, like, that's obviously a big number. That's basically the vast majority of all enterprise value that has been created in the last 50 years. Like the vast majority has come from VC-backed startups.
And also from the graph, I guess you can also see that most of it actually came in the past decade, if not less.
What really happened in 2017? That's the question. But I think it's a combination of different technologies is becoming extremely widely adopted, including internet, cloud, mobile, all these things coming together.
And it's probably not just that year, but also it was sort of like middle of the life cycle of a whole bunch of funds that started to invest in early 2010s, right? Like at the time when the mobile became a thing.
There was enough funds that had enough track record and experience and accumulated knowledge, but also a whole cohort of startups that were founded just after the last financial crisis, who then were suddenly nearly 10 years old, really hitting that breakout stage. So they'd done their startup product market fit bit after they were founded in sort of 2009, 10, and then everything takes off again.
Right. So startups basically drive the economy.
Exactly. And so that goes back, like we often hear, oh, this company is so big, you can't call it a startup. Like on the one hand, but on the other hand, if you think like that, like the whole point of a startup is to become big. This is why part of the reason why we're talking about it is just a factual observation that almost all value creation has come from these companies. So in a way, the point of them is to become super big. So if you have some kind of arbitrary cutoff point where you say, okay, no, this doesn't qualify anymore as a startup at all, you're kind of missing the point entirely.
Okay, makes sense. Yeah, if you can just reliably put them into these different buckets that are based on the stage, then I guess it doesn't make sense to stop calling something a startup.
No, at least you were born as a startup, and you clearly meet Paul Graham's definition of as a company designed to grow fast. Because if you don't grow fast, you cannot really become also big.
Yeah. Okay.
So there's only a tiny fraction of startups that does really make it big. So in Europe, about 1% of startups reaches unicorn stage. We'll get into a second what that means. It's about 2% in the US. But then, if you go further to kind of decacorn, centacorn, and trillion plus gigacorn, it becomes like even it's zero is still in Europe, of course, and 0.01% in the US. 0.06% reaches centacorn stage. So what that means is that 0.3% of companies create 2/3 of all economic value. And 0.01%, there's a typo here, my bad, creates 40%.
Right. And most of them are in the US.
Yeah, all of the blue there is in the US, and most of it in the Bay Area, which is crazy. But it's also because, talking about it's important to recognize that these are the types of companies that do grow massive. The Bay Area figured that out a long time ago. Everyone else is now sort of trying to catch up. They've realized it to an extent, but this is what a sort of 50-year head start looks like in terms of value created. Yeah. But I think the numbers in the title here are so important because a lot of people talk about 90% of startups fail. Well, actually, it's a much smaller percentage that actually matter in the end in terms of all the value that's created. And also beyond value as well, these are companies that generate a huge amount of jobs. And so they're really important for our economies in lots of different ways.
Right.
On LinkedIn, you see sometimes people saying like, oh, it's not all about unicorns. It's about creating sustainable companies, this kind of thing. And I kind of get where people are coming from, but and I understand the unicorn kind of fatigue, and we'll get to that in a second, like where it's meaningful and where not. But this idea that we shouldn't create billion-plus companies is crazy. It's actually not enough. Like you need much bigger companies, and that's the whole point.
It need in this case just to keep driving the economy. That's the need, because like I mean, what's the big difference between having, I don't know, like for the purpose of the conversation, like 1 billion companies versus 10 billion company?
I will explain why do you need it.
Okay.
So if you are doing something risky, probably you are going to fail. And so if you really want to innovate, you're taking a lot of risk, and you're probably going to fail. So to make up for all those failures, you need massive wins. Otherwise, the whole model doesn't work, and then you can't innovate. So that's the reason. And if you do create those massive outcomes, then the whole flywheel starts to work, because people, they start to make money, and you can take more risk. And that's what made Silicon Valley so powerful, as you can see on this slide, is that flywheel has started to work. So even if you are like, oh, I don't care about it, these outcomes, sure, but the model doesn't work otherwise.
Yeah, it's a good explanation about the money and risk cycle. I like it. I think it's a good explanation.
No.
As a bit of a sidebar as well, we don't have the slide in here, but this also compounds. So we had a look at how much the venture activity of the Magnificent Seven, because they've also become venture investors. They invest in startups, not just acquiring, but invest in startups. And the amount that they invested last year was equal to all venture capital raised in the EU. In fact, it was a bit more. So if you have
what does it say more about the EU's
well,
VC?
It means that if you have these big outcomes, it will compound. You win more than once from having these big companies.
So in summary, they matter. Startups matter. So why do startup definitions matter? So, well, as we showed, we work with a lot of ecosystems around the world, and traditionally people focus a lot on the kind of the levels. So how much VC was invested, how many unicorns are there, how many startups are there? Our clients are always very focused on that. They want to know exactly how many startups are there. And, sure, we try to help with that, but the more important thing is to look at throughput. So look at birth rates, survival rates, success rates, and to understand those. And so that's why we created this standardized framework.
How do you even see the birth rate of startups? Like they don't necessarily report to you when they get created.
Yeah, no, that's a great question. I think we have maybe a slide about it a little bit further on.
I'm gonna park it, but I will remember.
Yeah. No, absolutely. So starting with a little bit of data. So EIF, the European Investment Fund, it has invested in a lot of European VC. So it's a very complete data set. And they've put out research a couple of years ago showing that like 57% of their investments return less than a quarter, so are basically failures. I think a lot of them are zero or just being
write-offs.
Write-offs. So that gives you already a sense of the actual failure rate, and that's of VC-backed startups. So that doesn't even include the startups that didn't get funding. But then you also see that 4% of exits are returning 44% of the fund. So it's again that to the earlier point. There's a lot of losers, and you need a few really big winners for the model to work.
Right.
Like a bank is not going to give a loan on this kind of on these probabilities. Then you have another fund of fund, Adam Street, that's an investor in Index and Axel. So it's kind of a more kind of selective group of these kind of hard to get into VCs. So I wanted to show that as well. So you don't only look at EIF, but they also show that there's a high concentration. And their point is that as a VC, you can put actually most of your money into the winners. So that's the benefit.
And here the outliers are even more pronounced in terms of return percentage.
Yeah, exactly. So that kind of sets the scene. So we know that this is like there's a high drop off, and so it makes sense to visualize the startup ecosystem as a funnel, like a sales funnel. And it's about the throughput. So to give a sense of numbers, there are about 12,500 startups that raise their first VC round every year. That's worldwide. There is a current pool of about 150,000 active VC-backed startups, depending a bit how you measure it. That's roughly that number. And then you can see some of them make it through to like billion plus, 10 billion plus, 100 billion plus. Yeah, and so this slide is on one hand about to give a sense of numbers, but it's also about the mental model of a funnel.
Yeah.
And then people often say like, okay, but not every startup is VC backed. What about bootstrapping? And there is a lot of buzz around, startups are moving away from the VC backed model. I mean, maybe, but just looking at the data for a second and in terms of those very large outcomes. So yeah, there is over 50 examples of startups that have become really big without the help of a VC. So Atlassian is a well-known example. I see Checkout here, although, yeah, they did raise money, but
they raised at $1 billion valuation, right. So they hadn't raised before that.
Got it, yeah.
Yeah, I think it's still super interesting to track these companies, by the way. And one of the things that we found when we did some research on Central and Eastern Europe was that like a third of their unicorns were bootstrapped, which is massive. And it's like, if we look at the 40 there worldwide compared to 3,500. So what does that can tell us some interesting things about the region. Maybe there's, it's been born out of necessity because there hasn't been access to capital.
Most probably.
But there's a lot of great entrepreneurship going on there. Maybe there's a big opportunity for investors who could maybe have a look. So, I mean, it is definitely harder and they're much rarer to come by, these bootstrapped unicorns. But mapping these companies, can also tell us some interesting things about the world.
Yeah, I think in the CEU, I think when most of these companies were at a stage where it would have made sense to raise VC capital, VC funding, most of the VCs were so predatory that these companies decided not to go for it. Because there's at least like one thing that I know about that time in the CE industry.
Well, and it means that they've built some really resilient, massively revenue-generating companies out of necessity.
You see a lot of logos here, so that's really impressive. But it is we're talking about 1% of the total universe and 0% of the really, really big companies. Like it's very hard nowadays to think of a really big, successful startup that didn't get VC funding. So like, yes, we get it. It's super interesting to also look at bootstraps, and we do that. But if you can get, let's say, a 95% accurate picture of the entire startup ecosystem by using VC money raised as an indicator. It's not the goal in itself, but it's a pretty useful heuristic.
Okay, yeah, that makes sense.
One thing about unicorns, so this is about paper value, and we'll get to the definition in a second, but we've also started to look more at fundamentals. In Europe, we're blessed with pretty good resources about what revenue companies are doing. And so we've introduced kind of these new terms for startups with 25 to 100 million in revenue that we call colts. So the colts are like young horses, basically. And then thoroughbreds, it's a difficult term, but these are basically like, you know, when unicorns are like the mythical creatures which might do really well, but if you want to look at fundamentals, you can do that as well. So we've started to track both, and it's interesting to look at the overlap. So in this data here is about EMEA, so Europe, Middle East, and Africa. There are about 1,000 companies that have either reached 100 million in revenue or have this unicorn status. And in total, that's about 1,000 power law outcomes.
Interesting to look at this over time as well sometimes. So, for example, tracking which new unicorns are also a thoroughbred in 2021 compared to 2018 and things like that. So
that's like shows the level of hype in the ecosystem,
exactly.
I guess.
Exactly. Actually, we should have I forgot to include it here, but we have a chart showing 100 million companies and unicorns, new ones over time, and there's a huge spike in unicorns during the bubble. But then you see companies reaching 100 million is very consistent, also consistently growing, by the way.
So it's also like a good proxy to see the actual development of the ecosystem as a whole. Then
it's a less
better than VC money in this case.
It's definitely even better. It's also not a perfect metric because there are some companies that are clearly really, really promising, and they just haven't reached that level of revenue yet. And yeah, I mean, like look at Wave also or DeepMind at the time.
It was pretty clear, I suppose, at that point, even before they went like really to the scale up stage. That was a lot of promise.
Yeah, so it's end. You want to look at both. A thing about unicorns, since we're talking about definitions, so one of the top comments in the LinkedIn post is always like, "Oh, that's not a unicorn anymore because they exited." So yeah, okay, sure. Like the official, like when it was first coined, the term unicorn was kind of coming from the idea of pipeline, IPO pipeline, basically. Like I forgot who the world.
Eileen Lee.
Eileen Lee
from Cowboy Ventures.
So it was about still private companies that are already worth $1 billion on paper. So they were kind of these mythical companies. There were not too many, and like those might IPO soon. And they're not well known, but they're really valuable. That was the idea, I think. But since then, we started to count unicorns, and it became like a whole thing. So if you want to say, okay, how many unicorns has Amsterdam produced, then you, in my opinion, at least, you want to also count the ones that have already exited. If anything, those are more meaningful because they have realized that valuation. So usually when we refer to unicorns, we include.
So it's either funding or the exit.
Either on paper, so it's unrealized actually.
Okay.
Or it's realized through an exit. And then you have a bunch of edge cases. We don't need to.
We've done this work so that other people don't have to. But yeah, there's always edge cases when you're looking at some of these companies. Like FanDuel, for example, they were valued on $1 billion on paper and then exited below, and then they got reacquired over $1 billion again, and all this kind of stuff. So we've kind of mapped all of it, and people can have a look at the workings. But most of the time, it's fairly simple.
Right. Yeah, that's a lot of different possibilities that you can find.
But if a startup it hasn't exited above $1 billion, it was once a unicorn, and it's not. We now know that it's not anymore. Then we don't include it in statistics.
Okay, so former unicorn is not a thing.
We track them, but we don't include them as a unicorn number.
No, and they're, by the way, not as many as people think. Like we have done some research on it, and I think even looking at kind of momentum of companies where they haven't said that they're not a unicorn anymore, like we came out with an estimate of like 20% or something. So it's not like 80%, which is what some people were assuming.
Like that 80% of companies that were once valued over 1 billion are not valued at that amount anymore.
Right. And we think it's
crazy.
only about 20%.
I mean, I would say it's still a lot.
It's still, well, yes and no. I mean, you still have to think about, these are still, in a way, these are still companies that are going through through some phases. There's still risk involved. So if 90% of early stage startups fail, even at the unicorn, when you've reached unicorn status, there's still different outcomes possible. So it's also normal.
You also see companies coming back again, like that Vangel example. So they might kind of go back in the funnel a little bit, but they end up passing the unicorn valuation.
And are we mostly talking about private valuations or public valuations? Yeah.
Both.
Yeah.
Yeah. I wonder if there's a difference. We could take a look at another time.
What do you mean?
Like if there are different like outcomes for unicorns who are public and who are private, like in which of these two cohorts the percentage of former unicorns would be higher?
What do you think?
Probably private. Yeah.
Okay.
I mean, there have been a couple of examples where companies were held at 10 times the value that they could likely get in an IPO. And people are saying that, some companies are reluctant to IPO just because they don't want to, get confronted with their actual value.
I wonder if we're going to see more of that at the later stages of the AI hype cycle.
Maybe. There's a whole discussion also about private equity now, and in general, like VC as a subset of private equity. Part of its appeal is also that you don't have this transparency. So there is an incentive by some investors to keep prices artificially high. There's definitely some of that going on now. But just this is something we said earlier. So why do unicorns matter? If you can realize at $1 billion, that basically means, I think, I don't know if Eileen Lee came up with it because of that, but it just turns out that 1 billion isn't totally a random number. If you have 100 million seed fund, depending on how much you end up owning, it's 1 billion exit likely will return half your fund. So you can actually kind of see, like, for every 50 million that you raise as a VC, you need about one unicorn as an exit. And if you have one decacorn, you can return basically like a $500 million fund. So that's why they matter. We've shown that only like a fraction of VCs actually manage to invest in unicorns repeatably. So maybe it's a bit hard to read, but you can see just that there's an extreme skew and power law in how many investors can invest in more than one time, for example, at the seed stage in a unicorn.
Does it necessarily mean that most of VCs are basically not successful and they will not be able to return the funds at the coefficient that's expected by the LPs?
Yeah, totally. So just like most startups are not successful, it's pretty much the same for VCs, which is why we should be really careful what happens with government money and make sure that it goes to the right VCs.
Yeah, it's why LPs will make sure they're diversified across which funds they go into in the exact same way that VCs invest in lots of startups.
Yeah, I think we discussed it in one of the previous episodes that governments should not pick the winners, but they can very much pick the pickers.
I'm not sure I totally agree with that. Like, I think what LPs want is invest in the best investors and as much as possible. And maybe they will. So it's about getting access, actually. So if you can invest in whatever founders fund and you know, the all the big names.
Like it's
you
okay to
want
put all your like most of your money into.
Yeah, I think
doing it.
you want to diversify a bit, but not too much, I think. But yeah, I think that's different people have different opinions on that. So kind of summarizing what we just said. So if you look at the EIF data and Adams Tree data and kind of, you know, zoom out a little bit, roughly speaking, it seems that 5% of VC-backed companies have some kind of success. And success can also be like a 5x exit for, you know, that's probably not a unicorn exit, but it is in the hundreds of millions. That's still pretty good.
Yeah.
Still life-changing.
Works for me.
It works for me as well. It's life-changing for the founders. Perhaps also a nice outcome for some early employees, and it's a nice outcome for the VC.
Yeah.
Then you have this kind of 25% that is definitely not a failure, but just didn't get to the same type of exit. Maybe they will be part of a roll-up strategy, or they become profitable and independent. There are actually loads of those startups. So we kind of call them unsung heroes. And
for what reason are they usually undisclosed, these exits?
Yeah, that's a good question. I don't know. I think people, unless it's like really at a boast level, they just don't want to talk about it, you know.
Right.
And perhaps also if you become big enough, there is just more people involved, and so the chance also that it ends up leaking is also much bigger.
Okay, makes sense.
Just guessing.
Yeah, yeah.
And then you
then
end
the
up with
rest
about
is
70% startup failure of VC-backed companies.
compared to 90% of overall or more.
Well, the 90% is just sort of the number that's generally
Yeah.
thrown around, is why I referenced it earlier.
But this is something that we can back with data.
Yeah, exactly.
This is something you can measure pretty well, and you have like lots of reference points and research on it. As soon as you start to include companies that didn't raise, so that was your earlier point, you then need to define what is a startup. And like in our view, if a company isn't VC backed and it's really early stage, it is really, really hard to definitively say if it's a startup or not. And it's more edge cases than actual cases.
Yeah.
Like there are definitely companies where you can say, okay, this is like a typical startup. Clearly, like this person, everything they do says I'm a startup. And so we measure about 50,000 of those every year. But there are loads of companies that don't look like a startup initially, and they end up still becoming one. So it really depends what you take as a base.
Yeah, it's coming to your point earlier, Orla. That's the only the only description is like very qualitative in this case, right? So like you can't really there is no data to be able to say that okay, this is definitely a startup.
Yeah, exactly. And
before the first funding round.
Yeah, and one of the definitions that's used for startup or scale up is an OECD one, which is a company that grows 20% year on year for 3 years. But you can't be one of those if you've just started. For example.
Exactly.
And there are plenty of companies that, you know, on that chart before we showed the trajectory, there can be some ups and downs, or 20% can be could be very low in terms of a growth rate as well. So yeah, it doesn't tend to be too useful.
Yeah, so I think we wanted to just show also some practical examples of how we've applied this framework. So this is a slide. Actually, you've seen it before.
Oh, yeah, I have.
In Warsaw. So we did this report for the European Commission, like mapping startups that have been supported by their framework programs. So their grants mostly, and like it's just nice to see to map it out by stage, to look at kind of startup stage, breakout, late, unicorn, and thoroughbreds. That's more helpful than looking at how much funding they got in a single year, because if you just measure how much funding they received it's relevant, and we show it, of course, but that basically says more about the interest rate and than about those companies.
Yeah.
You know? And here you can see, okay, how many companies are there at each stage, and how are they progressing through this funnel, and how does that compare between the different countries? Like, are French companies doing, for example, progressing faster than Spanish companies? And if so, why is that? That's much more interesting.
Yeah. That's a good way to use the different. What's late stage in in this case? Because you said before that late stage is like a bad definition.
Yeah. So here, I think I think maybe someone twisted my arm so to call it late stage, but I prefer to just call it scale up stage. Yeah.
There we go.
Yeah. It's the same thing. Yeah. I think another kind of, this is something we've done for one of our customers, where you kind of look at, again, startup stage, breakout stage, scale up stage by founding year. So intrinsically, how old you are has nothing to do with your stage, but of course, older companies are more likely to reach later stages. So here you can also see if the graduation rates of startups has changed over time. Did your ecosystem get more efficient, for example, or not?
Right.
This is, I guess, the point that we wanted to make earlier about, okay, those early stage pre-funding companies.
Yeah.
And there, it is really hard to sometimes say, is it a startup or not? Nevertheless, the Dealroom signal, I can identify those obvious startups where it's like 90%. If a human would look at it, would say, yeah, obviously this is a startup. You can kind of think of it as, if a VC would look at it, would they consider investing in it?
Okay. But like, where does information come from? Is it like from the registries?
Yeah, registries, and we look at the people data. What's the founder's background? So if someone worked at a VC-backed company before and then they left to start something on their own,
there's a big chance that it's going to be a startup.
Yeah, it's usually either a startup or sometimes a consulting. Sometimes people start a consulting firm, which, by the way, can be sometimes people start as a consultant and it actually turns into a startup.
Yeah.
And sometimes people start working for a foundation, so that's also something else. Although in the case of OpenAI, I guess it turned out to become a startup. So you never know. It's actually a good example.
So it's always good to keep an eye on people who used to work for VC-backed companies, especially on senior roles, I guess.
Yeah, exactly. Yeah, totally.
Yeah, we also do a lot of work with universities as well to try and find companies, even before they're a company. So things that are coming out of innovation research on campuses. Often that's, deep tech, super interesting stuff that investors want to find out about as well.
So an example of where we applied this was on the investor ranking, where we kind of use this data to understand which investors are able to repeat power law investors. And that kind of, to get back to your diversification point, since on average VC is actually not a good asset class, if you fully diversify, you will for sure lose money.
Yeah, although I suppose I was thinking about some of the newer funds. So we also, because we kind of understand that if we're looking at funds that have invested in lots of unicorns over time, it does give a bit of a bias towards funds that have been around a long time to wait long enough that those companies become unicorns. We also did some analysis on newer funds, so ones that are founded in the last 5 years. And there's some really exciting funds that are actually outperforming for the same age of the fund, some of the ones that are in here as well. So some of those next gen investors, I guess I was sort of thinking about.
Yeah.
Yeah, and like I was just also thinking, like at the risk of asking a very dumb question, but like to what extent can this become like a self-fulfilling prophecy if we say that these investors are much more likely to be very successful, and then basically money comes to these investors, startups comes to these investors, and then of course they become much more successful because of both of these things sort of being combined.
Yeah, I think it definitely does. The branding for VC funds is really important. And if they're able to say that they've got a great track record, they're able to, on average, their startups get to later stages than other funds, then you're going to get better deal flow. Startups are going to come to you first, which actually makes those next gen funds even more impressive.
Yeah, exactly.
They're having to build brands often in very different ways. You can think of someone like Harry Stebbings, who's built his inbound pipeline from a podcast rather than from existing track record and brand, and he's been able to do that way quicker, and now he's got lots of unicorn returns of his own. So there's some really interesting models of how investors are building communities and all sorts of other kind of inbound pipelines.
I'm very curious to see what Project Europe is going to result in.
Yeah. What do you think?
We'll see in a couple of years. Yeah. I don't know. I really don't like the age limit, so I'm not.
Other things we have done, like we did research with Local Globe on the journey to Series A. So and there specifically, that's where we actually first used this kind of standardization. I think it led to a lot of interesting insights. It's still one of our most read reports. We recently did an investor value add ranking where we looked at which investors, based on the data, seem to be the most helpful to startups in improving their chances. And like what was really interesting is that the top investors have a conversion of from seed to Series A, standardized again, of 63%, whereas the bottom quartile has a conversion rate of 14%. So as a startup, it makes a massive difference who you raise from.
Wow, that's a really bit of like 2/3 against almost like 1 in 10.
Yeah, and there are some investors where it's like 90% or like above 80%. So Cherry is, for example, one that has been really at the very top. And that's something they are super proud of also. And then we also look not only at the kind of conversion rate and how much you raise, but also the quality of the follow-on investor. So if you then raise from a high quality Series A investor that has a high chance of or has a high success rate in backing really big winners, then we also kind of ranked you higher here. But it's all based on the same framework that we showed earlier. And so these were some of the names. We decided instead of doing an exact ranking because whether you have like 70 or 90% conversion, like it's both really good.
Right.
And you could also say that maybe the 70% conversion investor takes a bit more risk also. So like at some point, they're all really good investors. So we just rank them alphabetically.
Okay, well that's a good decision. So, but this cannot be recreated using the data from the platform then to actually have like the ranking.
No, I mean the top 50, which is the top 5% here, can be recreated. It's an Excel sheet with numbers, and that's all it is. And anyone who wants to see the underlying data, if they are one of these investors, they can ask for the data. And that many have actually. So we've shared it with most of these, and they've also I gave some feedback on some of the data, which was part of the reason for us for doing it, is to collect more kind of hard to find data.
Right. So this is your framework. How many other alternative frameworks?
There's certainly a lot of other definitions of a startup out there, I suppose. Who can say the work we've done here is a culmination of all of the analysis reports, research we've been doing for the last number of years, and so it's kind of it's not so much that we're trying to say this is how it should be, but this is the way that makes most sense for us, having worked with the data every day, and worked with many people in the ecosystem from all of these investors and got feedback constantly. So it's kind of us sharing. We think this is a smart, useful way to look at it, hopefully, but we're always open to feedback as well, and it's very useful.
But this is basically like open source in a way that can be used by anybody else for
absolutely
any purposes.
Yeah. So yeah, and I have not seen, and usually we're confronted with, I would say, like really basic stuff, like you said in the beginning. Often the term startup is just used for any small business that gets started.
SME.
Yeah, SMEs.
The dreaded SME.
Yeah,
label.
and for the purposes of creating all this economic value and in becoming more economically resilient and having a strong tech sector, which is the goal of this as well. Yeah, that's not a useful definition, I think. And then there is also a very persistent definition around startups that has something to do with whether you grow 30% like year over year, just not helpful. The intention we understand, but it just has nothing to do with reality. You create a lot of false positives and false negatives that way. And then there's the term scale up, which is all over the place. And sometimes it gets used that I think companies with more than 50 employees are a scale up. Which, I mean, there's nothing wrong with that, but we just set the bar really differently with that you have raised a mega round. If you wanna, if you really want to, create those big outcomes, you have to think bigger, and like the bar to be a scale up should be way higher.
Right. No, that makes perfect sense. So yeah, thank you so much. Thank you so much for explaining this, going through. I think it makes a lot of sense. And yeah, very happy to hear any feedback on this in the comment section or wherever else you can find us. I think it's always work in progress, and there's always some collaboration in this.
Yep.
Definitely.
Thanks a lot.
Thanks.